All right, welcome to today's Lunch of the Market. Our mailbag from you guys out there is getting overflowed. So we're going to go ahead and knock all of the questions out that we've gotten the last 48 hours today on Lunch of the Market. So thanks everybody for writing in and putting comments on the YouTube channel and the Twitter page and all over the place. So thanks everyone for tuning in, and let's get you the answers to those questions today on Lunch of the Market. So let's start off by talking about SLV. There's actually been a lot of questions on SLV. So if we pull up a chart of SLV, I think silver made another new contract high today. Okay, so the iShares Silver ETF is trading at $33.64, and at least certainly over the last year, that is the absolute 52-week high over the last year. Okay, so on SLV, January of 2012, 25 strike calls. That gets you in the money by quite a bit. Remember, SLV is trading at $33.65. So at 25, we're in the money by $8.60. Okay, so how do you decide on where to go in terms of how far in the money that you go? Okay, so let's show you how to do the math. Get out your calculator and follow along. Okay, so what you do to find out how much you're paying for time value, you take the current trading cost, the price where the stock or the ETF trades, subtract out the strike price that you're buying. In our case, it's the 25 strike. That difference turns out to be $1.15. Okay, $1.15 is what you're going to pay for time value. Does that make sense? Subtract the current price that the stock is trading at. Subtract from that the strike price. In our case, it's $33.65 minus a 25 strike. $33.65 minus a $25 strike. That gets you $8.65. That's how much it's in the money. How much your option is in the money. Then you're going to subtract from that the price you pay for the option. In our case, it's $9.80. That leaves you $1.15. That's time value. Okay, hopefully everybody understands that. So when we decide how deep in the money that we're going to go, we basically do that until the time value is small enough that we're comfortable with. At $115 of time value risk, I'm perfectly okay with that. This is going to buy us exposure to SLV all the way out to January of 2012, and there's no reason to pay more. If you go out to the 25 strike in January 2013, you're actually only going to pay about $1 more. So depending on how comfortable you are, right, for only $1 more, you're going to get an entire extra year of exposure to silver. So it really depends on how long you want to stay in the trade. January 2012, January 2013. Now, when it comes to leaps, a misconception is that you have to stay in the option all the way until expiration. You do not have to stay in the in the option until expiration. If you achieve your profit target, whatever that is that you set on your personal portfolio, then you can pull the ripcord and get out of the trade. Again, you'll pay an extra $1, so there's $1.15 of time value in the 2012 25 strike SLV call. You'll pay an additional $1 for time value all the way out to January of 2013. You do not have to stay in the trade either until January of 2012 or January 2013, but the longer out you can go on the curve, the more likely it is that you'll be right. Okay, so that's the question on SLV. I think we had several users. Looks like at Corey Bolton, at TradeFast, both asked about SLV. Okay, at 4U2Race, they asked about FSLR. Okay, that's First Solar's ticker symbol. Okay, let me say blanket statement right now. I don't like solar exposure. It's too dicey, it's up and down, and the reality is that you need government subsidies to make this technology affordable. Right? People are not just running out and buying solar. It's a great thought. It works to a certain degree. There are some power companies that have taken advantage of solar, and use it as part of their portfolio. But on a large scale, solar is not a viable option. And so while you can get in and out for trades, okay, this user right here at 4U2 race, they asked about, it looks like they're holding put spreads in the 140, 135 put spread. If those are March, move on. The stock is about $7 away, and with high oil prices, there's no reason to believe that First Solar is going to go down between now and 18 days from now on March the 18th. So move on. When you play a bearish bet for us, I want to incorporate some kind of seasonal weakness into the mix. And so that's a great segue into the question from @honey25908 about Apple, saying that when they saw our piece on Apple, they really like the idea of a bearish trade on Apple. How do they pull it off? How do they incorporate it? Well, first of all, we were long the stock. So selling the upside call, the July 370 call, gave us tons of money to then go out and buy a downside put. So that was the first move that we did on Apple, was a caller, a stock caller. And then sure enough, the stock went through 355. Apple's trading around 349, but it got all the way down to 339. We actually exercised our put, made somebody take the stock when it was at 339, and then we went out, and this should answer the second part of their question, and bought the January 2013 300 strike call. January 2013 300 strike call. I don't really want to take a look at the January, they asked about the January 2012 330s. Look, if Steve Jobs makes his exit either from mortality or from the company, I think you could easily see that stock blow through that 330 call. Now, at that time, if you wanted to get long the 330 call, I'd say you have your entry point, right? You're going to see 2, 3, maybe 4 days of selling an Apple. On the second, at the end of the second day, or sometime on the third day, you could look to go in and buy Apple calls and go out on the calendar as far as you're comfortable with. But I really, really do not want to put on any long positions in Apple ahead of that inevitable event, right? It's going to happen, right? You get pancreatic cancer, mortality rates are 5 years. This is the third medical leave of absence from Steve Jobs. And so the risk that's out there to that stock is too great for us to either be short put spreads or to be adding long stock positions. But that doesn't mean that we don't want to stay long and protect our positions. So that's why we have the put butterfly on. A put butterfly, sorry, finger charts, guys. A put butterfly, go back and watch the Decker's video if you need to see what a put butterfly looks like. A put butterfly is simply a long put spread and a short put spread, boom, where this strike is shared by both sides of the spread. So you're using this part of the spread to go ahead and pay or reduce the cost on this side. So there we like the July 2011 350, 300, 275 put butterfly. Okay? 350, 300, 275 put butterfly. Okay, hope that helps. That should answer Apple, that answers silver, that answers First Solar, right? Looks like you're going to have to get out of that trade. Sorry, it's not an exciting place to be right now. And I think if anything, there's a slightly bullish bias to solar right now with oil creeping upwards. And if we see oil creep upwards, you could probably continue to make money in those. But I don't know that you want to be placed on the bearish side of solar right now. But I also don't know that you need to go in there wildly bullish. Okay, last question. So I have two responses to this question about MasterCard. First is, MasterCard is not my favorite name. Visa is our favorite name. Why? Well, it's a bigger payment processing company, right? Visa processes more payments than MasterCard does. MasterCard trades at $243 a share. Visa trades at $73.54. Okay, anytime you get Visa under 70, you have a green light from us to go buy the stock. Green light, Visa under 70. Can you enter a position here? You can initiate at $73.50, but I don't know that you want to lay out the kind of capital to go into a MasterCard when Again, Visa is a bigger company. MasterCard has been traded much longer in the publicly traded space, and so its valuation is, right, in terms of a market cap, has gone up quite a bit. The other play that I really like is, right, who's really the next biggest way to process payments around the world? eBay, right? E-B-A-Y, eBay. They own PayPal, which I think is an unbelievable franchise. It may even be worth the entire price of the PayPal stock. But I think you're going to see eBay trade as a retailer. So if oil prices go up, you could see pressure on a stock like eBay. Today it's down almost 2.5%. And I think that completely ignores, right? You should see eBay, Visa, and MasterCard all trade in tandem because they're just plays on payment processing and the increasing number of transactions that will take place away from paper money. So I like eBay, we like Visa. You could dip your toe in Visa right here, but I wouldn't go gangbusters because you want to leave yourself room to buy more if it breaks 70 to the downside again. If it never breaks 70 to the downside, that's a high quality problem to have. Thanks so much, guys, everyone, for writing in. Join us again tomorrow for Lunch of the Market, and be sure to mention us, follow us, and Facebook us at MO Financial. Thanks for tuning in and have a great day.